Hello, dividend growth stock investors. A very happy Sunday to you. It is Colby, the DGI Crab, and it is time once again to talk about the undervalued stocks in the market that we can take a look at going into the upcoming investment week. It's always good to have a plan, and that is what this is all about. In case you're new here, this channel covers a list of 60 of the highest of quality dividend growth stocks, real blue chip companies in the dividend growth investing community. But I've taken those 60 stocks and I've separated them off into 4 individual categories or tiers based off of the age and time horizon of the investor, which I believe is the most important metric that any dividend growth stock investor should take into consideration. If you're younger, you want to get those really aggressive dividend growing compounders that don't necessarily have a great starting yield, but over time will really start cranking out the money. And then for the older investors who don't have as much time in the market, if they're still trying to acquire passive income, they've got to get that yield right now. So, with that being said, let's just jump right on in here and see what we've got for the week. Now, I'm not a licensed professional, so do your own due diligence. These are just my strategies for investing. Hopefully, I can give you some good ideas. The way that I allocate my money, for those of you who are not familiar, is I put half of my money each week into age-appropriate ETFs for automatic diversification. On the individual single stock side, I'm looking for stocks yielding at least 30% or more above their 4-year average yield to be in my personal buy zone. Couple of exceptions to that rule for me is that I will buy any of my top 10 favorite stocks among this group of 60, sometimes even if the value isn't amazing, just because I want to make sure that I have good, strong positions in these 10 companies for the long haul. And I do try to remain within my own personal age tier, my own group of stocks, but if I do see a stock yielding at least 50% or more above the 4-year average yield in a different tier, I will reach up or reach down and add that stock, because I think that not only am I getting a much higher yield on cost than I typically would get from that stock, but I'm hoping I'm going to see some price appreciation as well, buying a stock that's down. That's called value investing. And then if there's not a buyable stock within my age tier at any given time, I will not invest less. I'll just add more money to ETFs that particular week. It is as simple as that. We always want to keep that passive income moving up. So as I move on into the spreadsheet where I track all of this stuff here, let's start with the top 10 favorite stocks. So these are my personal top 10 favorites: Pepsi, Procter & Gamble, Union Pacific, McDonald's, Coca-Cola, Waste Management, Exxon, Johnson & Johnson, Microsoft, Visa. If I only were to invest in 10 individual stocks, this would be my personal list right here. And with this group of 10, Pepsi is the only one that looks to be particularly undervalued still, a 4-year average yield of 2.95% compared to a current day yield of 3.79%. That is 28.5% higher starting yield than it typically has yielded over the past 4 years. Guys, this top 10 tab is a great reason why, over the long haul, an investment strategy like this works. You can remember, even though Pepsi's underpriced right now, within the last few weeks or so, if you've been purchasing shares the way that I personally do, you were adding Pepsi when it was sub $140 a share and have a nice, hopefully very low dollar cost average on your Pepsi. We also, at one point in time, were buying, remember, Johnson & Johnson shares down around $150 a share or even less. Johnson & Johnson now looks overpriced at $190 a share, and I will always continue to remind you guys, I started buying Microsoft a couple of months back when its current day yield was just basically about the same as the 4-year average or a little higher. At that point in time, Microsoft shares were down in the $380 a share range. Recovered all the way back up to 510, and now we're pausing, not selling, just continuing to reinvest our dividends and let those runners run. Okay, guys, so the tier 1 stock. So this is the category for the 18 to 30-year-olds. Lower starting yield, aggressive 10% plus year-over-year dividend growth. That's what I'm trying to get out of this group of stocks. Still have my three dogs in this category with Nike, United Health, and Nordson as the only three squarely in my buy zone. Nike had gotten out of that top spot and had been replaced with United Health, but United Health has made a bit of a recovery here. Still looks very underpriced at $354 a share, but Nike and United Health, these have been the stocks that have presented you with a long-term buying opportunity for this year. Their 4-year average yield is going to continue to go up the longer that they stay down, but both still look very appealing. Nike's recovered into the mid to high $70 a share on multiple occasions. Right now, dipping all the way back down here to 65. If you were tired of buying Nike shares in the 70s, I think it might not be a bad idea to start talking yourself into getting excited about buying them in the 60s at this point in time, because this just seems too low. And then Nordson, close, but not quite out of the buy zone just yet. I'm still adding this dividend king if I'm 30 years or younger. I'm very confident I'm going to get some really high quality dividend growth and a current day yield that's a little bit better than the S&P 500. And then also in this category, again, waste management, yielding right at the 4-year average, which for me, when it comes to waste management, that's just about good enough for me. I'm not going to add any waste management personally this week unless it drops a few more dollars a share. But if I was still in my younger years, in my 20s, I'd definitely be taking the opportunity to build up this position. Tier 2, age 31 to 41-year-old investors. A little bit higher starting yield in this group. We're getting up more into the 2.5% to 3.5% range. We still want to get high single-digit annual dividend growth of like 7, 8, 9% most years. And with this group, we've got some opportunities here. We've got the most undervalued stock of all 60 on the channel is Target, which continues to nosedive. Target did just announce, as I showed you on my video yesterday, a dividend increase for the month of September. It's a small increase of just under 2%, just like in 2024, but they're keeping their dividend king status alive, even though their share price is down. Getting Target with a starting yield this far north of 5% just seems kind of amazing to me, actually. I know that there's reasons to be concerned when stocks drop this far, but this is also how you get value. You've just got to trust that a company that's increased their dividend for more than 50 consecutive years in a row without fail is going to find a way to continue to navigate through these waters. You're not going to get great dividend growth on Target probably right now like you used to get a few years back. But Target also is a bit cyclical with their dividend growth. If you go back and look at the history of the dividend increases they do, there's a lot of 2-3% years and then a few 20% years thrown in there here and there. So it can be a little bit unstable as far as that goes. But if I'm starting at this far north of 5% yield, you're paying me great money to wait on that recovery. American States Water, Starbucks, McCormick, excellent stocks for me personally to add up on this week because I'm going to be graduating from tier 2 into tier 3 early next month. And this group of stocks is not going to be my primary focus for much longer. Glad I was able to build up that Hershey position, though, before it recovered. Great timing there, Hershey, for me personally. Thanks a lot. And then, of course, keep your eye on Union Pacific and McDonald's. Top 10 favorite stocks for me, slightly higher starting yield than usual. I'm not quite cheap enough yet for me because I've got so many other deals I can get right now, but that's probably going to be a couple I'm looking at close. Tier 3, age 42 to 53. Just Hormel is square in the buy zone, but it's way undervalued, and it, like Target, just continues to fall. I am going to enjoy the high starting yield that I'm getting on Hormel right now. They're going to pay me to wait for a recovery. I think it's eventually going to happen, you guys. But man, I mean, if you're concerned about Hormel, I don't blame you. I think they're going to be okay. But again, great starting yield, pushing 5% on Hormel right now. My goodness. A reminder again, there's Pepsi, the second most undervalued stock in tier 3, the most undervalued stock in my top 10. You know I'm still buying Pepsi, you guys. Still hitting the buy button on that Pepsi. And this week, if I can find some extra cash, I've still got some some money to invest in my Roth for the year. So the real estate investment trust here, AMT, is looking appealing for me personally right there. And Procter Gamble, 15% undervalued, plenty good enough for me when it comes to Procter and Gamble. And after a long time of being quite overvalued, Coca-Cola is now yielding a little bit higher than their 4-year average yield. Not quite ready to buy Coca-Cola yet, but definitely one to keep an eye on. And then tier 4, you guys, age 54 and older, we haven't been seeing value in this category for really since the entire time I started the channel over a year ago. But now what we see here out of this group of 10 stocks is we've got 5 of them that are yielding 10% or more above the 4-year average. I'm not jamming the buy button just yet, 54 and older investors, on these individual stocks, because I do think you've got high yield ETF options that I think are going to be more stable and less risky than an individual single stock just inherently. But definitely keep your eye on the high yield stuff, you guys. It's finally starting to come down a little bit. We're getting a better than 10% starting yield on Ares Capital Corporation. Not remarkably undervalued, but that's 11% higher than the 9.15% 4-year average yield. Um, One Oak, after doing that merger with MMP a while back, One Oak shares shot up to $100 a share, which to me was just way overpriced. And now it's coming back down to earth. Not quite ready to grab this one just yet, you guys. But when that yield starts to get into that 6.5-7% range, One Oak's going to look pretty good to me. Okay, so let's talk about dollar allocation. You guys, this is how I personally handle it throughout the years. Tier 1, those younger investors, a 25% allocation into the S&P 500, 15% into small cap value, 5% into dividend appreciation, VIG, and 5% into VYMI, my only non-US stock investment. And then for tier 2, same 4 ETFs, different emphasis with VIG getting the 25%, VOO and VBR getting a little bit less. Tier 3, SCHD, VYM, DHS are great examples of ETFs of this category that I really like. These are all featured on the Great ETF Race series here on the channel. Go check out the Great ETF playlist here, and you can see what investing in things like SCHD, VIG, VYM, etc. look like over the long term, even if you're just doing a little bit each and every week. Tier 4, 10 different ETFs, 5% allocation each. And since there are no stocks clearly in the buy zone for tier 4, once again, I've been preaching the virtue of the ETF double down. Whereas instead of doing a 5% allocation in each of my ETFs, I'm actually doing 10. With the exception of VYMI, I keep my international investing pretty strictly at 5%. So I don't double down there. But if this is 95% of my investing capital for the week as a tier 4 investor, where's that extra 5% going to go? Well, I'm going to throw it at Target personally, yielding well above 5%. That's plenty enough starting yield for the income seeking investor, and it's still going to give you some long term potential for both capital appreciation and dividend growth. For the young investors, where do they go with that extra, with that 50% allocation into single stocks for tier 1? I'm going UNH and Nike as my top priorities. And then Nordson, Waste Management, Pepsi, Target, Hormel, all worthy of some attention here. Tier 1 investors, you get a shot to buy some stuff with 5% yield like Target, Hormel. Enjoy it while you can. Tier 2, lots of great deals. Target, American States Water, McCormick, Starbucks, Pepsi, UNH, Nike, Hormel, Procter Gamble, Waste Management. All nice options here for the Tier 2. For the Tier 3, a little bit more focused with Hormel and Pepsi, I think, being the top 2 things, with Procter Gamble, Target, UNH, and Nike bringing up the rear. So that is the allocation and the strategy for the week, you guys. So what are you buying out there this week? What has you excited in the single stock realm in particular? For me, I think that Pepsi and let's see, if I had to rank them, I'd say Pepsi and UNH are both still just so appealing to me right now at these current prices. And while Target and Hormel feel risky, I do like the higher starting yield, and I think their dividends are safe. What do y'all think? Talk to you next time.